Okay, gentlemen, ladies and gentlemen, welcome to our ICG seminar. Sorry you guys were early, we were kind of late. Okay, it's going to be conducted in English and Chinese translation afterwards. Okay, 我们今天这个讲座是很欢迎大家参加我们这个 ICG 的公司讲座。我们这个主要是以英文讲解，然后呢，这讲完之后呢，有什么问题呢？你们提出，我们用中文给你解答。Let's start quickly. Basically today, we're gonna show you why the gold price is 448 yesterday, and it has never happened since the past 20 years. And today we are lucky to have Millennium Bullion Fund, which is the first mutual fund in Canada that will allow you, the investor, to invest directly in physical gold, silver, and platinum bullion. So that's the physical one, not speculation, not paper, not stock. And Mr. Nick Bergman is the innovator in this, setting this thing up. I call you Nick. Nick started 1997 researching about this concept. And in 1998, he come to a conclusion that he wanted to do this. And he filed for OSC. And it takes 3 years for them finally to approve it. So 2002, this fund is launched. And 2003, it was approved in Ontario. And then 2003, it was approved across the country, including Yukons and, Nanawa, whatever it's called. So basically, I would welcome Nick. And without further ado, Nick.
Thank you, Fred, and thank you everybody for coming. I know everybody's busy on Saturdays. I am. And has things to do, so we'll try and get through this efficiently and give you a brief overview. I like to start. I brought a small bar along because so that everybody fully understands that we're talking about bullion. I only brought the silver bar because a gold and a platinum bar at this size would have to have several security guards. I can take the risk. But you can appreciate, people are often surprised when you actually hold real bullion, the effect in terms of the weight, and it's impressive. So don't put this in your pocket. Yeah, your pants might fall down if you put it in your pocket.
这是真正的黄金啊，这个黄金纯金啊。
What I like to start with is in precious metals, there seems to have evolved a number of what I call myths and misconceptions that make it hard to really understand the precious metals unless these myths and misconceptions are cleared up first. The first one is that the central banks around the world have sold their gold. They don't need it anymore. Financial paper money and derivatives and so on have replaced it. The second one is that conventional equities, stocks, are actually better investments than bullion. The third one is that mining stocks are better investments than bullion. And the final one is that there has been very little demand for gold, silver, and platinum, and that's why the prices have been down over the past 20 years. When you examine these, you'll find that all of them are untrue. In the case of central banks, there have been sales that every time there's a sale, Australia, Belgium, Canada, Netherlands, the United Kingdom have sold gold from the central banks over the last number of years. But the sales have almost been rebalanced by other countries buying. So for example, China, France, Germany, and Taiwan central bank have been buying gold for their central bank while Western central banks have been selling. The result has been that the amount of central bank gold over the past 20 years is almost unchanged. It's been the same. The issue of stocks being a better investment than gold is also untrue. This graph shows a percentage change from 1971 here through to today. The yellow line is the gold line. There was a big increase in the 70s, pull back through here. And this line is the Dow Jones. The period that the stocks had outperformed gold has been this period here. We're at the point now where gold is again outperforming stocks. So this entire period from here, gold was better than stocks. This period, stocks were better than gold. This period, they're even. And now we're diverging where gold is better than stocks. When you compare to mining stocks versus actual bullion, this is in the 1970s, and the mining company Homestake was the biggest mining company at that time. They're one of the oldest. They were in existence since the 1920s. And during the 1970s, you can see the gold and the mining stock were initially similar in terms of increases, but toward the latter part of the bull market, the gold itself dramatically outperformed the mining stock. And that's typical, and we expect the same thing to ultimately happen here. The silver bars that we actually hold in the fund are 1,000 ounce. They're about this big, and they're 80 pounds, so that that would be hard to pass around today. The other issue has been the question of the price has gone down because there's low demand, nobody wants it, so the price goes down. That actually isn't true either. If you look at this graph here, it shows the total production in green, the demand in blue, and the red line is the deficiency between supply and demand. Since about 1988, right there, the demand was about 1,000 tons a year greater than supply for gold. In silver, you have much the same thing. You've got the demand in blue, supply in green, and since this time frame, the deficiency has been 10,000 tons a year in silver. In platinum, it's been relatively balanced because there's never been any above ground stocks to make up the difference. So platinum has been relatively even through this period. So the question becomes how can the prices go down if there's not enough supply in the first place? And that was one of the things that intrigued me when I first started looking at this in '98, was that you haven't got enough mine production in the first place, and yet the prices were going down. And what this leads to is that and this discussion here we could probably spend an hour on, so I'm only going to glance over it. But basically what was happening is that there was an artificial supply put onto the market through a concept called leasing. Leasing is a bad name for what this really was. I would consider it short selling. But what would happen is that mining companies and other hedge funds would borrow gold from the central banks. They were allowed to sell the gold, take the money and do something else with it. In the beginning, the mining companies took the money, built the mines with it, and repaid the central banks out of production. But later on, speculators began doing this because you could borrow the gold for 1% interest rate. Hell of a deal. Because at the time, treasury bills were 5%. So if you borrowed at 1%, reinvested the proceeds at 4%, you made 3% for nothing. The problem with it was, though, that if the price went up, you'd have to go back into the market and buy gold, and potentially at a higher price, in which case that became a very dangerous game. In total, it's unclear what the estimates are because there's never been any good statistics on what the numbers are, but different experts expect it to be between 5,000 to 16,000 tons of gold have been leased, and that's made up the shortfall. That's also been the mechanism that's kept the price down. In silver, it's been 31,000 tons. But as this price of the metals, which has been happening in both, all three, silver, platinum, and gold, have been increasing, sooner or later, the people that borrowed the gold are going to have to go to the market and buy gold in order to pay back the loans. So when that happens, there's going to be an extraordinary spike up in the price far beyond normal supply-demand characteristics. In 1999, the number of central banks, primarily European central banks, signed an agreement called the Washington Agreement. And they agreed not to sell more than 400 tons of gold a year or to increase their leasing programs. That agreement was renewed this September, and it was renewed at 500 tons, and so far no gold has been sold even within the 500-ton agreement. So that limits it, and it was from that period in 1999 that the prices of gold and silver started to move up. This, what I call a short position, which means someone is short the metal and they eventually have to go and buy it, consists of three things. The mining companies will eventually have to buy metal to get out of their short positions. The leasing that we've talked about is going to have to be covered, and there could be a situation in the futures contracts where the entities that sold commodities contracts without having any gold or silver will have to go to the market to buy to deliver. So these are just some extraordinary conditions that may apply in the next little while. With the myths issue kind of out of the way, the other thing that many people confuse or don't fully understand is that these three metals, gold, silver, and platinum, have two distinct roles, and they're different from all other commodities. In all three cases, they have uses as industrial commodities, and they are also monetary assets. Gold and silver have been money for 5,000 years in most countries. Paper money that's not backed by gold has only been a phenomenon since 1971. It's been a 30-year experiment. All other such experiments throughout history have failed. This book, Gold Wars, talks about all the other, and it actually started in China in terms of when the whole concept of paper money got created several hundred years BC. In the commodity area, there is a strong case to be made just as an industrial commodity. Gold, silver, and platinum are critical metals in numerous high-tech applications that cannot be replaced with any other commodity. So there's no choice to use something else or something cheaper or whatever. The uses of silver, of platinum, and gold are unique in the application, and there's no choices. In the computer area, the new evolution to very small microchips all use gold. The better quality CDs that you use in computers, they're all gold, etc. And platinum, they have uses as catalytic converters and so on, that type of thing. Silver has exploding number of commodity uses. So there's a very good argument to be made that the three precious metals will grow in demand as industrial applications. But the second area of monetary demand will far outpace the industrial commodity demand for these metals. And that comes about, first area is geopolitical risks. Whenever there's war, terrorism, price of gold goes up, everybody moves into gold as the safe haven. We're also getting into an area that is being called competing currency devaluations, and that is that as the US dollar declines, other countries will attempt to move their dollar down to maintain the export competitiveness with the US markets. Japan has been doing it the most blatantly, in that they keep trying to keep the yen down so that they maintain their export competitiveness. Eventually, all currencies will begin to decline against gold and silver. The other area that now, the first time in 50 years, the Chinese markets have been opened so that Chinese citizens can buy bullion for the first time in 50 years. That was just set up 2 years ago for gold, 1 year ago for silver. So there could be potentially a huge additional demand in China just as a store of wealth and so on. Final area that's relatively little known is the Islamic dinar. The Islamic dinar was the currency of choice in the Muslim countries several thousand years ago, and it's come back now in a modern form. It's based on both gold and silver. It's each the silver dinar and the gold dinar is defined as so many ounces of silver. But instead of carrying pockets full of heavy metal like that, it functions much like a conventional banking system. You have debit cards, you can write checks, but the bank holds gold and silver, doesn't lend it out, and charges the customers storage fees. But you can write a check in so many grams of silver and pay for it with a check. You don't have to, carry bags of coins around. But at the same time, you can ask for physical coins anytime you want. So it's going back to that. There's some discussion that the ultimate movement is to price oil in dinars. If that happens, big problem for the US dollar.